So when we look at like adjusting trades, whether it's options or equities or futures or whatever, you can really make adjustments to anything, and there's different ways to do it. So we'll start out kind of by talking about like ways to adjust, why we adjust. So we can adjust like the actual structure of the trade. So I kind of like to think of it in like two baskets. Like we can adjust the structure of the trade, and we can adjust our risk or our position size, right? So we can add risk to a trade by adding to our position size. Now, I never want to do this if it exceeds my risk tolerance. So what I almost always do when I put on a trade is I don't put on the full allotment all up front. I give myself flexibility, whether I'm using margin or just putting on a pure cash trade. I give myself flexibility to add to the position if I need to in a worst case scenario. So that's one way we could do it. Like what's a basic example of that? Well, let's say like I buy, 100 shares of Apple, and of course I want Apple the stock to go up, but let's say that it doesn't. Let's say, I buy 100 shares and the stock goes down, but let's say that I could have actually bought, based on my risk tolerance, I could have bought 200 shares of Apple. So the stock moves against me. Well, a way to make an adjustment to that is to buy the remaining 100 shares. Since I've allocated 200 shares, I just didn't buy them all at once, at a lower price. Right, so that's a very basic example of an adjustment, right? But we're not necessarily changing our outlook or changing the structure of the trade. We're still long shares of Apple. We've just added to our risk. We've added to our position size. For me, this type of adjustment is a last resort. So this is, I kind of jumped ahead, but this is step 2. I don't want to really add, I don't want to expand, we call it expanding our position. I don't want to expand my position unless I've already exhausted my options, which are going to be in step 1, which is to actually adjust the trade. So to actually adjust the structure of the trade, right? And that can be done by actually changing the trade itself. And this is where we kind of get away from stocks. We can't really change stocks other than that we can add other vehicles, right? We can add options to a stock trade. We can sell calls. That's an example of an adjustment. We own shares of a stock. Maybe it's trading sideways or starting to move down. I can sell calls against my shares to lower my cost basis and bring in a premium. That's also an example of an adjustment where we're not adding the position or increasing risk. We're changing the structure of the trade. Okay, so that's what I'm talking about. But certainly when you get into like options, there's a lot of flexibility to change the structure of a trade. So we can change the actual initial trade itself. We can also do kind of like what I talked about with the Apple example. We can use other vehicles even to make an adjustment. And I actually just gave a real life example of what I did with my VIX call spread, right? Where I bought a VIX call spread, didn't immediately, I've been holding the spread for a few weeks. I've still got 42 days until expiration. But I didn't get the VIX spike that I was looking for in the first week or two. So I went and sold premium to finance the cost of my VIX call spread, but I did it in a completely different asset. So that's also an adjustment, but not to the initial trade itself. I adjusted by using another vehicle. So this is really the first step when I make a trade adjustment is what can I tweak to the trade itself that's maybe not working, or maybe it's not that I don't think it's going to work. My forecast or my outlook hasn't necessarily changed. It just hasn't happened in a certain time horizon. So maybe, like in this actual example, I want to adjust it because something in the market maybe didn't occur or changed in the near term, but it doesn't really impact my medium to longer term outlook. So I still am confident the VIX is going to spike, and I think it has a strong likelihood of spiking in the next 42 days. So I still want to hold this trade. But what I did is I sold premium to finance the cost of that call spread and pay for it, and then book the profits on that. I'm already out of that trade, and now this is a free trade for me. So that's another way to adjust. But this is really my first step, is to first look at how I can adjust the structure of the trade. If I've kind of exhausted all of my my options, to make an adjustment to the structure of the trade, then that's where I might look at adding to my position or expanding my position. Some strategies, like I'll give an example, are very difficult to adjust the structure of the trade. And so a lot of times you with those types of strategies, you'll need to really put on low risk up front, don't over leverage, and you do need to expand the trade. An example of that often is like a credit spread. Credit spreads can be rather difficult to make adjustments to. You've got both a long and a short strike in your spread. And that creates a number of different difficulties when it comes to making an adjustment. And so one way that I'll adjust a credit spread, if it doesn't work out, is I'll put half the spread on when I initiate the trade. So let's say I can allocate 10 contracts based on my risk tolerance. I'll put on 5, right, up front. And then if the trade works out the way I had intended, great. I book my profits. And the only trade-off was I didn't make double the profit on 10 contracts that I could have put on. But so that's a trade-off. But the benefit is, if it didn't work out, I can expand my position by putting on the other half and going to 10 contracts by adding 5 if the spread moves against me. And that way, and this will become kind of more clear as we talk about premiums in the options contracts, but that way, if I just maybe got my timing wrong and the thing like reversed on me and I was in the hole, but then it finally went back in the direction I hoped. I mean, that happens to all of us, right? We make a trade and we feel great about it, and then all of a sudden it goes the opposite direction you anticipated, and you're like, crap, I just lost. You take a loss on the trade, and then you keep watching the stock, and sure thing, like it's almost like the market's like targeting you, right? The next day, like the thing goes right back up in the direction you thought it was. Well, this is where trade expansion, can help overcome that type of scenario, because if you give yourself that flexibility, well, I can expand my trade, add to the contracts, lower my cost basis by selling more premium, for instance, at lower strikes, and giving the trade more time to play out. And so that's the beauty of options. It gives us that flexibility with a variety of expirations and strike prices to play around with. So the good rule of thumb, like when we're making an adjustment, is look at what you're being debited versus credited. So like a simple example is like selling a put, right? Let's say we sold a 155 strike put on Apple. Well, Apple, or let's go with 160 further in the money. So we sold a 160 strike put on Apple. Well, Apple is trading below 160, and our 160 strike puts are now in the money, right? And that's what we don't want to have happen when we're short a put on a stock. So if we look at the premium here, at the mid, we're at 560, right? Expiring in 3 days. So let's say Apple does in fact expire below 160, right? So these remain in the money at expiration. And I want to utilize a rolling adjustment. Well, rolling simply involves buying to close the short premium, so that 160 strike, and then reselling to open it a further out expiration. But I only want to do that if I can get an equal or greater credit. Well, in this case, yeah, I could do that. We can go out to, if I were to roll today, I can go out to the 160 strikes that expire February 24th and see that I can collect 675 at the mid. So I can collect a bit of a net credit. So why is that so important? It's important, and we call this staying net cash positive. Okay, so if the stock doesn't go back up, let's just say it stays flat, right? Or it goes back up, but it doesn't get back above 160. By utilizing rolling adjustments that stay net cash positive, and again, what that means is we're collecting a greater credit than we're being debited from the adjustment. The stock doesn't have to recover back above 160 for us to achieve a profit over time. Now, we may have to do one of these adjustments more than once, but all it really requires is a drop in implied volatility. That's enough. Implied volatility is the major component of option pricing, right? Option premium. So even if the stock stays flat and doesn't move at all, implied volatility is going to come down. And the reason this works so well with selling puts is that when a security goes down in price, implied volatility goes up. And so that actually benefits this type of adjustment, because if you look at, let's just say, look at a chart of Apple, and let's add implied volatility to the chart, right? So what happens? So look, as Apple's going up back in May, June, July, implied volatility is going down. But then the stock hits resistance and sells off. What does implied volatility do? It goes up. So they're inversely correlated. So why is that good? Well, if I'm short a put, I don't want the stock to go down. I want it to go up. So if it's going down, implied volatility is going up. But that's good for my adjustment strategy, because implied volatility goes up, the premiums get more expensive, and I can roll for a greater premium. Now, after this Apple sell-off, the stock just went into a range for a while, right? For a couple months. Implied volatility came back down during this period. So the stock didn't necessarily have to get back up here, but look where implied volatility ended up. Back down at lower levels. So even though the stock didn't recover, so if I had rolled a short put that was in trouble here when implied volatility was high during the sell-off, I can roll for a net credit. And even though the stock went into a sideways range for a couple months, implied volatility came back down. That allows me to capture premium on that rolling adjustment. So that's an example of like using it on a short put. But the critical take-home lesson there is that you roll for an equal or greater credit if we're going to make a rolling adjustment. A credit spread, again, you may want to be more aggressive with adjustments, but you can also set your own rules. Like some people will adjust if they're selling option premium, like let's say they're selling credit spreads, they'll adjust when the market moves past their short strike, or some might wait till it moves past the entire spread, or some might wait until a factor on the chart. I do both. So I could, by all means, wait to adjust a credit spread till the day of expiration if I'm looking at the chart and I notice that we're approaching a major support or resistance level, and it would make sense to see how that level either holds or whether it holds or breaks, right? And then make the appropriate decision for the adjustment. So I do it both in combination, and then of course take into account the strategy itself that I'm adjusting. For instance, like with stock, which again is kind of, as we started out explaining adjustments tonight, is probably the most basic adjustment you can make is buying more shares, called dollar cost averaging at a lower price. If I were just to buy shares of a stock like Apple, maybe I get in at the absolute wrong time, like up here at 175, and then the stock tanks. Well, as part of my trade plan, before I buy the shares at 175, I'm going to allocate a certain percentage of my total risk capital, and I'm not going to put the whole thing in all at once. And then if something occurs like it did in August, September, October, I will have in my trading plan that, okay, well, I bought shares at 175. What if the stock goes down to 140? Well, it did. Then I'm going to buy more shares at 140, right? And then I've effectively, if I do that in 2 steps, like let's say 100 shares at 175, 100 shares at 140, then I've effectively actually bought the stock right in the middle.